there's been the mention of sandboxes from time to time. This is the soapbox portion of our program, where each of our speakers gets to say a few words about themselves or their organizations. And Garry, I think you shortchanged yourself a little bit at the beginning of the program today and didn't say enough about yourself or AFC and the excellent things that it is doing, but particularly with regard to what sets AFC apart from many of the other trade associations, and that is the principles that it adheres to. So I'll let Garry go first and own the soapbox for just a few minutes.
Sure, thank you, Con, and I will try not to take too much time because many of you get to hear me speak quite often. But yeah, in terms of my own background, I spent about a decade on Wall Street as an investor, and then came to Treasury on TARP, where I overlapped a little bit with Comptroller Sue, who we'll be talking to in a few minutes, and then was at the CFPB, and I've been at Financial Health Network before I came here. Yes, I mean, AFC tries to do exactly what Manny Alvarez was saying in the panel before. We're trying to balance innovation with consumer protection, commerce, and consumer. Those need to work together, and those principles really are around transparency, around affordability. So we have advocated for rate caps in different jurisdictions. Obviously, any of those who spend time around rate caps know that depends on what state for what product and how that's defined, but we are looking for ways to have a profitable industry that does that through competition and not excess rents from consumers. And so I'm grateful that I get the opportunity to lead an industry group where that's at the heart of what we do. With that, I guess, Con, should I mention a few of the things that I'm focused on the consumer protection side, or should we?
Well, why don't we'll leave that to the Q&A if that's okay. All right. Thanks, Garry. Lauren Saunders is the Associate Director of the National Consumer Law Foundation, and many people ask, where did 36% come from, or why 36%? To find the answer for that question, that profound question, one need only read Lauren's seminal article called "Why 36%?" So, Lauren, here's your soapbox.
Well, thank you. Thank you for that. I'm glad to know that somebody's reading it. So I'm the Associate Director of the National Consumer Law Center. We work for economic justice for low-income and vulnerable consumers. We're based in Boston. I run our DC office. We've been around over 50 years now. We were originally started to be consumer law experts for the network of poverty law programs, legal services programs around the country that help people with their legal issues. We still do that. That's very much in our DNA. It's helping low-income consumers, the people who are really struggling day to day. We've, of course, broadened beyond that. We publish a series of consumer law treatises. You'll see the yellow books behind Chris. Thank you for the promo there. And hard to find time for them, but we all write them, including myself. We work with a network of consumer attorneys, advocates, policymakers. We do trainings for consumer attorneys and AGs, very active in the legislative and regulatory world. And we are always looking out for ways to make sure that consumer laws are enforced, that people know what they are, know how to use them, know how to apply them to new situations and places where they need to be improved. So we're definitely got an eye on fintech and looking at evolution in the marketplace and things that have promised to help consumers, as well as things that might be more on the evasion side of things. Always happy to partner with forward-thinking industry players, and definitely appreciate AFC for inviting me to this panel and for being a partner on some consumer protection initiatives. So thanks for having me.
Okay, Lauren, I apologize. I renamed your organization the NCLF. It's the NCLE. So
National Consumer Law Center.
Clearly looking over your right shoulder. Chris Peterson, a profoundly respected professor at the University of Utah, you're a little bit at a disadvantage because your soapbox consists of bragging about the University of Utah, I guess. So maybe you can tell us what a swoop is.
Thanks for having me, Con, and thanks, Gary. It's fun to join you all on the panel. Swoop would be the mascot. It's a falcon at the University of Utah. We're the running Utes, but so anyway, that's I'm a law professor at the University of Utah. I've been working on consumer finance issues for most of my career. Also did a stint at the CFPB, actually overlapped a little bit with Garry, although we were in different offices at the time, but worked in the CFPB's enforcement office and also worked for Director Cordray in his front office for a few years. And also they sent me over to the Pentagon, where I helped on the Department of Defense's Military Lending Act regulations for a while. So we're just really excited to be here and dive into some of the substantive issues that everybody's interested in talking about. So thanks so much, Con.
Professor Peterson is too modest. He didn't just help with those regulations. He wrote them, it's my understanding.
Well, there's a lot of people. Tom Scanlon, who's now, I think, at Dorsey and Whitney, did a lot of the writing too, and maybe even a little bit more than me. But yes, I did help. I'm comfortable with help.
Okay. Nat Hoops, how are you, Nat? We are going to get the vertigo following you around your office there, or wherever you are.
Great, yeah. I had to move because it gets loud and busy here. But
okay,
happy.
Probably needs no introduction. The former head of the MLA, the predecessor organization to AFC, now at Upstart, where he's in charge of public policy. And a well-known figure in the fintech and marketplace lending industry. Nat, tell us a little bit about Nat and Upstart.
Sure. Well, thank you. As you mentioned, helped lead the predecessor of AFC, and really agree with Gary's sentiment that one of the things that's unique is that we do reach kind of across the divide and try to form these alliances with consumer advocates over a long period of time around this 36% rate threshold. And when we started having those conversations a few years ago, I think we really surprised a lot of people because industry groups just don't usually do that, and then consumer advocates don't usually find partnership with industry groups. But I think what we found overall is that when that partnership emerges, it creates something really, really powerful because it's so unexpected. And so, whether it was the Illinois law or the California rate cap or the Small Business Borrower Bill of Rights, we really kind of got involved in a lot of these efforts. And Garry has really picked up that mantle and built a whole consumer advisory board with the Woodstock Institute and others. Really because it has a chance to make a big difference for consumers, to kind of wring some of the excess out of consumer credit and make sure that there's open and fair competition below that 36% threshold in the sort of standard installment loans that we all help provide. Upstart, as many of you know, provides technology services to a few dozen banks and credit unions now, and helps those institutions lend below 36%. And it really can help increase the inclusive lending. So I would say if you are a thin file borrower, a borrower of color, you can expect if Upstart's model is being used to be approved about 30% more often than a traditional FICO model. And so that access and inclusion focus is really at the DNA of our company, and one of the things that I love working on here in DC.
So that's a great advertisement for our 1.5 million viewers. You owe a special payment to Garry for that advert. Let's have a lightning round for all of our panelists. It's 2026. We're here at our 11th summit, AFC summit, and and this is about the consumer. And we want to know what the ecosystem has done for the consumer in the world of fintech. Lightning round for each of you. What is going to be the most profound impact on the consumer of fintech, including AI and machine learning, crypto and payments, DeFi or any other form of fintech that you can think of? What do you think is going to have the most impact on the consumer over the next 5 years? Starting with you, Garry.
I'd probably say what I've been saying for 10 years. So it may continue to be wrong, but I think payments continues to be the place where you can really bring down the cost of having money, which is a first place I start before we even talk about credit. Is how expensive is it to hold your money, move it from digital into analog form, so cash into a card, back and forth. And I think that remittance across, borders, all of those things combined with hopefully some movement both at the Federal Reserve and at the largest banks, that system will be massively improved. I don't want to make predictions about how much that will come from one of the players or not, because I think we're right in the middle of some decisions about how much of that will be privatized and how much of that will be public. But I think payments will continue to have a substantial impact on consumers.
Chris, what do you think?
Well, on the plus side, I think that I agree with Garry that payments are being transformed. I mean, the difference between, writing checks and paying for something on Venmo, just not picking out one company in particular, but I mean, obviously it's really transformative. I some negative things that I think are coming too. I mean, we're seeing a lot of lawlessness. I mean, the ability to have transnational scams and to manipulate the public through having very detailed information on how to market to them and take advantage of their vulnerabilities, both in ways that are explicitly illegal, on the borderline of whether or not they should be legal or not. And also just even marketing legal products, but maybe the ones that are not to the consumer's best advantage. I'm very troubled about the massive hoovering up of information that speaks to people's most vulnerable moments. So I'll stop there. This is a lightning round, so I better cut it off.
But I tend to agree with you. Lauren, what does your crystal ball tell you and us?
I would say the use of data, algorithms, artificial intelligence, that whole big soup is going to have the most profound impact, I think, for good and for ill. For good, obviously, we have the potential to have services really tailored to the consumer, have easy way of doing responsible things like underwriting and ways that don't put burdens on providers and lower costs. Getting information to people when they need it at the right time. At the same time, I fear that we've got tremendous hurdles with respecting privacy, with making sure that data is not used to target people, to exploit their vulnerabilities, to use behavioral mechanisms to push people into doing things that really aren't great for them to do. And I know regulators today are certainly looking out for disparate impacts. We know that there is redlining in cyberspace like there is in the physical world, and I think that's going to be very, very difficult to root out.
So we have payments, we have foreign actors, and we have data aggregation. What do you say, Nat?
I actually think that the revolution in data and AI and machine learning is going to really create a whole new world in the credit space. And in particular, I think that a traditional lender, if you look at the way they would approach a personal loan market, they will, even in their advertisements, say, if you have above a 700 credit score, you can get approved in this much of time. And if you just look at and they'll often even disqualify all candidates below a 680 or 700 credit score, and they'll just say that's our cutoff. And so if you look at what AI and machine learning combined with big data allows you to do, you eliminate that massive, basically, disqualification that hurts borrowers of color, and you bring them back into the game of where they actually have a chance to be approved for credit. When often they've done nothing wrong. They've never defaulted on a major loan. It's just that they didn't have the same advantages of having their parents sign them up for credit cards early in life and building sort of a long credit history. So I think that revolution in data and machine learning and AI, if it's well overseen, if it's well regulated and supervised, I think it has a huge potential to increase inclusion and access for people who have been shut out.
Yeah, great. All great observations. So taking it from 5 years in the future to the moment, We're almost in, hopefully, the post-COVID era. We will be in the post-PPP era, the post-CARES Act, post. And in that era, the metrics of lending have been scrambled. Garry, you pointed this out. What does that do to providers of credit? What does that do to consumers? What does it do to regulators when all of the past metrics for underwriting are now out the window, and in terms of employment and job tenure and so on?
Maybe I'll take that for a minute.
That's for you. Yeah.
Yeah, and this will also allow me to advertise. Next month we'll be holding a webinar. We'll get the information out to folks on this issue, bringing together folks from scoring to reporting, underwriting, and collections. But it is true that we are in this. We've been in this secular change around what data is being used to make these decisions. But we're in a cyclical moment where we went through this massive disruption in the economy, which normally would lead to high levels of default, falling credit scores, and a whole series of other things. But because of very prominent and effective efforts by the federal government, we've seen people lose employment and see their incomes rise and their liabilities fall. And things like the child tax credit may provide a more permanent floor for a number of families. So that, combined with the CARES Act's requirements around people are being entitled to things like their credit score pre-pandemic, as long as they have been current, those things are going to make this difficult. So I don't have any answers other than we're going to be convening folks. We actually been talking to the National Economic Council at the White House, because this is something that I think regulators, providers, advocates, the legal community, everyone's going to have to hold hands a little bit on this one, because we have a backward-looking system, and that backward-looking system already has challenges. It will have even more profound challenges. And the last thing I would note is that the secular change in the types of data that is available for use, combined with this unique moment, gives us an opportunity maybe to be really aggressive. So one of the things I've talked to the Treasury and the National Economic Council about is undertaking a project to try to separate as best as possible race from risk. Because in the United States, those two things have become deeply intertwined in much of our systems. And because of the last 2 years and this whole new change in data that's available, it might be the time to at least try to undertake something which to me in the credit world is almost like the Manhattan Project, where you are trying to radically rethink. But I think this could be an opportunity for us. But we're going to all have to cooperate and collaborate, because it will impact all of us. And at the end of the day, it's the consumer that we all serve, regardless of what role we're in.
Yeah, so one of the problems with messing up the credit histories of people through a pandemic is that it opens up the door to potential predatory lending. And that opens up the door to the question of a 36% cap on usury limits at the federal level, which just happens to be one of the principles of the AFC. And since we have on this panel, do you prefer to be called the mother of the 36%, Lauren, or or what?
I'm certainly not the mother. It goes back over 100 years, and I'm getting old, and I'm not that old.
Okay, then you're at least the sister of the 36%. And I've often wondered for a while, and Chris and I have had conversations about this. It's obviously a fraught political issue, but it can be discussed in polite company now, whereas 5 years ago it could not be discussed in polite company. And I'm reminded of the Regal-Neal Act, which allowed interstate banking only because each state was allowed to opt out of it, right? So what if you passed a 36% usury cap at the federal level, but allowed each state to opt out at the same time? That they could opt out because they were on the low side, or they could opt out because they were on the high side or had no usury. But it would be up to them, and they would bear the consequences. Any thoughts on that? Laura?
Well, I think that would be a bad idea. I
Okay,
think that's not a whole lot different from the system we have right now, where states can pass laws to cap rates, or they can, not cap rates. And people in states where the legislatures are less concerned about consumers, where there are very well-heeled lobbyists for the payday loan industry, and they're pushing, it just aren't going to get protections. So I think we need a national 36% rate cap. I think responsible lenders can operate under that. Obviously, AFC agrees. 36% is a really high rate. And every single time I talk about my work to somebody outside the Washington Beltway, the reaction is, oh, that's too high. That's horrible. And we in our little Beltway mode, get in these debates, but it's got ample room. And I think it's time to just do it. We really appreciate AFC's support, not just that the members stay under 36%, but that you're out there actively supporting it. It's a way of differentiating responsible lending from irresponsible lending. And it's got to be uniform, and people need the same protections no matter what state they're in.
Chris, you've given this issue a lot of thought. What are your views on the 36 cap?
Well, I mean, generally speaking, I think I agree mostly with Lauren. I think that I think one of the things that's hard for folks in industry to see is that they see all the complexity in complying with 50 different state regulatory environments, which I agree is very difficult. I did a study once where I tried to map out the highest permissible rate in each state, and like the number of methodologies and exceptions, it just multiplies and becomes very challenging, and that's a real concern. And I think that it's one of the things that's holding fintech and more innovation back is the fact that you can't get people like Lauren and I to agree to big reforms that might facilitate innovation and better business, because we don't have any speed limits or seatbelt laws in a lot of places around this country that take advantage of low-income people. In my own home state of Utah, we have no interest rate cap, and we have widespread, rampant 600% interest rate loans where the lenders are suing low-income people who tend to be disproportionately from minority communities, but also just a lot of poor white folks like I was when I was growing up, and suing them and getting them literally arrested at their places of work because they don't show up to the small claims court lawsuits. It's an unacceptable, barbaric system. And it's hard for us to talk about, sure, we'll meet you halfway with a new sandbox proposal, or we're willing to entertain some new, alternative, payment processing system, or maybe a new non-interest based, faster payment on a salary product, when that kind of thing is going on through large chunks of America. It's time to have some basic consumer protections so we can have a more unified system that takes care of people in a better way.
So,
and can I just add that it's it's innovation friendly. It's simple to enforce. Everybody knows what it means. And it's an alternative to things like the CFPB's payday loan rule, which had to go through, excruciating detail of how to underwrite payday loans and what kind of ability to repay analyses they needed to do, because they couldn't trust them to do it right because the interest rates are so high. And they, of course, didn't have that authority. So it aligns the incentives. It's not perfect. You can still have, predatory or expensive lending under 36%, but it aligns the incentives so that responsible lenders can't, charge exorbitant rates and have to care more about whether the loan is sustainable.
Yeah, I agree. Unfortunately, it runs against the zeitgeist of the time in terms of federalism. And that's why I thought the opt-out for the states might have some appeal. But it also opens up the door to a discussion about Madden and bank partnership lending through fintech. It's surprising to me. 6 years ago, when we had this first summit, that was almost all we talked about. Madden was fresh and new at the time, and it's no question but that it's shaped and I would say impeded somewhat the progress of fintech lending, and yet Madden hasn't been mentioned until I just did a second ago. Congressman McHenry alluded to valid when made and true lender, but he didn't pursue it at all. Nat, could you give us the state of play with respect to Madden and true lender and valid when made? And assume for the moment that the audience really doesn't know what Madden does.
Sure. Well, I think if you think about an arrangement where there is a legitimate technology provider and a legitimate bank, and everybody is playing their roles appropriately and properly licensed as, you know, a servicer, a broker for what they do, and the bank is clearly the lender. If it makes a loan, you know, it can apply its home state interest rate in the state. In Dodd-Frank, you know, where my boss was the 60th vote, and we worked really hard on a lot of consumer protection, creating the CFPB and all of that work, you know, it still clearly recognized that there was rate exportation. That said, you know, there have been actors in the past, and you know, most notably often in the sort of tribal lending area, but also at times in the banking area, where the bank is really just not taking proper precautions, controls of the lending program they're doing. And they're essentially just renting their charter out to do whatever type of lending in theory is legal in their state. And so that's really the kind of true lender issue, where you have this question of you know, did the bank really make the loan or not? And then the Madden issue is really separate, which is, let's presume the bank really was the lender. In the case of a lot of the lending that the fintech industry has really helped to accelerate, the funding for those loans, the banks that have really jumped onto the bandwagon of saying people are in too much credit card debt, they have too high a rate on their card, and we need to help them refinance out of that credit card debt at a lower rate. The real interest in funding those loans have come from the broader capital markets, that there haven't been the banks that have the balance sheet capacity who want to do a lot of that and then hold the loans in perpetuity. And so for the whole thing to go effectively, the loan needs to be recognized as valid when made. It needs, if a bank made the loan, it was the loan. And then the terms of that loan need to be enforceable down the chain of the capital markets. And so that's really the issue that was brought into question in the Madden decision. And you know, there's been a lot of back and forth, and there's rule, you know, now a rule from the OCC and the FDIC out on that that does reaffirm valid when made. But ultimately, you know, valid when made only works if the bank is really the bank and doing the right thing in taking control of the loan program, overseeing the loan program, following all the applicable law in its home state, and really running a program that's one that I think all the consumer advocates on this call would say, those are good loans. Those are not abusive loans. Those are sub 36% loans. And in the states where there is no rate cap, you always have that possibility that a bank will try to exploit its charter to do abusive lending. And I think that's where over time, what is happening is more and more conformance in the growth of AFC, I think, is a testament to that. I think the growth of the sub 36% platforms are a testament to that. You're just seeing an acceleration of the good lending, and there needs to be that cop on the beat that Lauren mentioned at the state level to find out how to make sure that charters are not abused. So I hope that helps.
It's very helpful. Thank you very much. Most of the 1.5 million listening to this call or watching this cannot afford a high-priced lobbyist in Washington, but Chris Peterson happens to have worked at the CFPB, and he knows Rohit Chopra, and he can give us an insight as to what to expect in the coming years under the new administration of Mr. Chopra.
Yeah, sure. Well, I mean, lots of other folks on this call too. Obviously, Garry worked at the CFPB as well, but I did work a bit with Rohit, a little bit at the CFPB, but also Rohit and I worked at the Consumer Federation of America together. He was, before he went to the Federal Trade Commission, he you know, did a small stint there, and I think they hired me as his replacement when he became a Federal Trade Commissioner. Look, the thing about Rohit is, first off, he's brilliant. He's a very smart guy, and he's very intuitive and understands people quite quickly. I think that Rohit is going to be fast. There's going to be a lot of stuff coming, I think, if I know him at all. And I don't think that he would disagree with that. I anticipate more enforcement cases. There's going to be more reports, more regulatory rulemakings. I think probably buckle up. And I think you also can see that from some of the early staff hires that he's picked. Jan Singelman is the chief of staff, and Jan worked in Senator Brown's office before this. But before that, he was just down the hall from me in the CFPB enforcement office, and he was a real grinder. He would get his work done, constantly doing hearings. He just moves. And also, Seth Frotman is the acting general counsel. Seth was Rohit's replacement as the student lending ombudsman, and then later resigned, I think, noisily in protest during the Trump administration, and formed his own a nonprofit organization and ramped that up and got its budget all funded. Seth is going to be creative and is going to be open to a lot of interesting ideas about how to push the law forward. So I think that you can anticipate that there will be searching review of new ideas to see whether or not they are helpful to consumers and whether or not they dot all the I's and cross all the T's on the law.
That's very helpful.
I want to jump in, Con. One quick thing to reinforce what Chris said that related to our industry. He mentioned in his first testimony, which I thought was really interesting, that he feels that not enough consumers are refinancing out of their high cost debt. And he also took that lens of the Federal Trade Commission, his prior lens on antitrust. And he says, I want to promote more competition, much more competition specifically in consumer finance. Right. And so, for all of those on the call and everyone listening, I think that it would be a mistake to think, oh, buckle up. It's all the bad news for, the fintech industry, for anybody else. I actually think the opposite. I think that Rohit takes a very aggressive, but also a very pro-competition, innovation, and making sure that the consumer knows that they don't need to be stuck in their big bank credit card at 29%. Like they need to figure out how to get out of that.
Well,
I agree with that, Nat, by the way. That's really smart. I 100% agree with that.
Picking up on that theme, let me ask one quick question of Garry. Congressman McHenry made the point that the Build Back Better agenda is sucking the oxygen out of Congress. And my question is, if the Build Back Better program passes, and we'll probably know in the coming days or weeks, and between infrastructure and reconciliation, we're talking about $2 to $3 trillion. What opportunities, if any, and I assume there are some, Garry, do you see it in that for fintechs? Unmute.
Sure. There are a couple things that come to mind. One, if the child tax credit is made either permanent or extended long term, I think that there is a real opportunity for some households to deleverage, for some households to be able to get themselves on a more steady footing in terms of saving. I don't want to pretend like it's a cure-all. It's not, but this is the most substantial program for anti-poverty program we've had since Lyndon Johnson. So there's a lot of potential there to make a lot of households better equipped for themselves, but also better customers, and be available to responsible players to actually help them manage a financial life that is not structurally impossible to manage. So we've had no real wage growth for decades with high inflation for healthcare, education, and housing. So for many of those families, they've been filling that gap with very high cost credit. So I do think that there's an opportunity that comes out of that. And then I think another part is between what we've seen with the PPP program and what could happen with infrastructure and other pieces, I think there's a real opportunity to think about, and 1071 from the Bureau, a rethinking of small business banking, financial services, which intersects a lot with consumer. That is a massively underserved, poorly served, actively destructively served market that I think could create real opportunity. So those are the two places that I would look.
Well, thank you. Thank you, Gary. And thank you, Chris. Thank you, Lauren. Thank you, Nat, for all of those insightful comments. I suspect that Phil is going to appear on the screen any moment now, but before he does, let me just conclude by saying that we live in a dangerous neighborhood, this fintech neighborhood of ours. On the one hand, we have predatory lenders on the lending side, and on the payment side, we have crypto used for ransom payments and other nefarious activities. And the takeaway for me is that it's so important that we police ourselves. And that's why an organization like AFC that is principles based is so necessary and so valuable.